Comment. Members of the public are invited to address the committee regarding. Is there anyone wishing to speak from the public?
Chair, totally off the the normal thing, but for those of you who like chocolate and are used to the truffles at the December meeting, my wife and I are teaching a class on how to make the truffles on November 15th at the Lafayette Library. The cost is $0, so it's priced well, and you get to take truffles home plus learn how to make your own.
Wow, cool. November 15th, okay?
6 p.m.
I'd rather you just bring them.
Well, I can do that. I'll do that too.
They taste so much better. So is there anyone else from the public wishing to speak? Approval of minutes?
So move.
Second.
First and second. You got it, Christina? Call for the vote. All in favor?
Aye.
Opposed? Consent?
Move approval.
Second.
Have a first, second. Any discussion? Call for the vote. All in favor?
Aye.
Aye.
Opposed? All right. Regular agenda items, 8.0, legislative update.
Good morning, Commissioners. I'll give you a brief update on some federal items. You do have a report in your packet from our federal advocacy firms, and I think the one thing to note is under the grants section, they talk about the Advanced Transportation and Congestion Management Technologies Deployment Program, which is a grant that we had submitted an application for, and unfortunately we were not successful for that. So we are arranging some time to talk with DOT to find out, what they can tell us about our application and how we could potentially improve it for next time, because there should be future funding opportunities in this arena coming up in the next year or two. Other than that, it is election season, so there's not too. Oh, go ahead, Commissioner Tatson.
I was going to let you finish, and I was going to have a comment.
I was just going to say it's election season, so there's not too much happening in regards to grant funding and other transportation items at the moment, but they will be reconvening, I understand, in early December, so there may be some opportunities there as well.
So, Mr. Chair, I had a question. So I understand we weren't one of the successful applicants, and I'm glad that you're meeting with DOT. If we have the capacity to look at it, I would like to understand at some future meeting, are there ideas in the successful applications that are relevant to our county that we could disseminate to the jurisdictions? Because it struck me just from the descriptions, there were some things that a number of us might be interested in.
We can certainly take a look at that. I think what we've heard indirectly is that a lot of the award recipients for these grants were cities that applied for the Smart Cities Challenge with DOT, and they had only selected one winner for that. So this was an opportunity for them to fund some of the other ideas they thought were great as well. And with that, I'll turn it over to Mark Watts, our state advocate, for an update on what's happening at the state level.
Good morning. I'm pleased to be here. I got done in plenty of time. Traffic seems to be running okay, so cheers. Give you a brief update on what's going on in Sacramento. As you know, the legislature finished in late August, and the focus up there has been on two separate different activities. One has been monitoring and watching the DMV deal with autonomous vehicles, and I'll come to that in a moment. The other is the unfolding potential for a special session to be convened before the end of November, which would be the date it would expire under the Constitution. Lots of focus on it. I've this week drafted a constitutional amendment at the request of Senator Bell to protect whatever new revenues are generated, and I've also spent time with Senator Bell's staff drafting several reform items that the Republican members have asked for. So lots of daily activity building towards a potential. Will it happen? It's hard to say. There are some complications. Initial interest was early, right after the election, because that's a customary time frame for the caucuses to return to Sacramento. But then you have the layer of Prop 54, which requires, if that passes, which it looks like it will, that requires that legislation in its final form be still for 72 hours in print, available on the website and in print in the Capitol. And so you can see if the election's on the 8th and they come back on the 10th, there's not enough time to do that. So they're checking calendars and looking for something later in the month, probably closer to the week before and the week right after Thanksgiving week, which gives you a very, very short window. So lots of logistical issues being ironed out, and then there's still, do they have the temerity to call people back after they've either won or lost, or however they've done in the election, and present a package that's acceptable to them. For the two chairmen, I'll just say I hinted at the activity of Senator Bell by the work he's involved several of us in. He's very, very plugged in and conducting weekly sessions, reaching out as well to other members. And Chairman Frazier, and for his part, is doing a very, very rigorous member-by-member outreach within his caucus to develop support. If you recall, the two chairs have identical bills pending right now. Chairman Frazier has actually had his staff work to develop fact sheets, very detailed fact sheets that would demonstrate to a member what kind of activities would result if they supported that bill in their district. Kinds of road programs and transit programs, ATP programs, and other that would materialize. Probably the toughest issue that I've run into so far, and I'll make this very quick, is how to deal with transit, because I think at the time the bills were being conceived, there was a hope that they could fund about $300 million from cap and trade. Not sure that that's going to happen. And then the other piece for transit was an increase in the current source for transit grants, which is sales tax on diesel. They would both propose to increase that. That's about $200 million a year. But if cap and trade doesn't show up, there's a worry that that not enough is being developed to enhance transit so that they can address their state of good repair needs that they have just as much as the highways do. So transit is going to be something that's difficult to develop a hard bright line solution to, and there's a lot of work going on right now on that. So with that, that's what I would brief you on in terms of the potential between now and December 1st. And then after December 1st, the new legislature gets seated the next week. So it's a whole brand new ballgame at that point in time with a whole large number of new members who haven't been briefed as to the needs. So the dynamic shifts a bit. On the autonomous vehicles, the DMV did conduct a workshop in the wake of the federal government having issued their guidelines. And I think uniformly the industry said this is very good development. DMV, you've kind of moved the ball ahead, but you've got a couple of areas of conflict that we're still not happy with. And that ranges from data sharing requirements. Most of the industry is not real happy with the data sharing, and I won't go into any details on that. Municipal permitting is in the DMV, which is not in the NHTSA guidelines, and so some are reviewing that as having 3 layers of government in order to allow an autonomous vehicle entity to test their vehicles. And then there's also the actual issue of whether the guidelines that NHTSA had developed on safety checklist, which they clearly made it voluntary. They said, we'd really like the OEMs and the folks who want to test their vehicles to submit a checklist with addressing a number of issues and bring that to NHTSA. And they also suggested that the states shouldn't make it mandatory. Well, DMV's initial round of proposals would have made the checklist submittal a mandatory step. So there's a disconnect between NHTSA, DMV, and how the automobile and autonomous vehicle manufacturers and developers are looking at the two entities. I'm certain it'll be worked out over time. There's some very powerful interests, ranging from your traditional mom and pop Fords and Chryslers to smaller companies like Google and others that are involved in this. So I think at the end of the day, you'll see the legislature and DMV begin a lot of advice and see how it goes. So that would be my report for today, and I'm happy to take questions.
Okay, thank you.
Sorry it's late, guys. It's those traffic lights in Orinda. I got to talk. You know somebody I can talk to about that?
Traffic lights in Orinda?
Yeah.
You drive to Orinda and then catch BART? Is that what you do?
The what?
You drive to Orinda and then catch BART? Is that what you
No,
do?
I drive all the way here through Orinda
Oh.
on the dam road.
It's that damn road. It's that damn road.
That damn road, yeah. Okay, so where are we? Item 9?
Yes, sir.
Interstate 80, San Pablo Dam Road Interchange Reconstruction, Phase 1. Authorization to execute amendment number 1 to utility agreement number 381 with the Pacific Gas and Electric Company for utility relocation services.
I'll handle that, Mr. Chairman. Good morning. Good morning, board members. We are asking you today to approve Amendment 1 to Utility Agreement 381 with PG&E, which will increase our share of the relocation cost of their line from $386,464 to $550,167. This is an increase of about $163,000. But before I get into the details, let me start with some good news about the project and share with you an update on where we are. The new pedestrian overcrossing was opened actually to the public on Tuesday last week, October 25th. This is less than 9 months from the start of construction. This will provide the kids with at Riverside Elementary School a safer way to walk and bike to school without having to cross Amador Street. So we're very happy with that. The contractor on the job is working hard to substantially complete all the work on the project before the end of the year, despite the many construction complexities we had to deal with in the field. Some of these complexities, we had a number of utilities we had to deal with in the field. As you recall, we had Phillips 66 line, 54-inch East Bay Mud water main line on El Portal Drive, and several overhead lines we needed to relocate. That included PG&E, AT&T, and Comcast. We moved most of them, especially the 54-inch and the Phillips 66, way before the construction started. But some of the overhead line work lingered on, and actually some of it wasn't done until the construction of our project started. And that caused delays. In some cases, we found out that some of the underground utilities owners didn't know exactly where their lines were, so we were encountering conflicts in the field, causing it. Most recently, we had to deal a new requirement on the asphalt.
That's the off button.
Oh.
So we had to deal on a new requirement on the asphalt mix, and maybe Ivan can give you more details on that. That's expected to cost us an additional $340,000. We also placed work hour restrictions on our contractor once we received complaints from the public on noise, as well as to try to minimize the traffic impacts on the freeway. So we gave him very limited hours to work during drive operations, for example, for the sound wall in El Portal Drive. All of these, unfortunately, all of these factors has increased the cost of the project. As you may recall, we decided to move forward with awarding the contract with a reduced contingency on the project. We normally have a 10% contingency. This one, we awarded it with 6% contingency. And we deferred any request for additional funding from our partners until we actually need that money. So since the costs have increased, we are going to be seeking funding from WICTAC, Sub-Regional Transportation Mitigation Program fees. As you know, that program has about $7.1 million earmarked for the project, and so far we have not received any of that money. We will be submitting and asking for about $700,000 at the December WICTAC meeting to help us cover some of these cost increases. Just as a heads up too, we have a conflict with a difference in opinion with East Bay Mud on who's responsible for paying the relocation cost for their for their lines. And we agreed to pay for it, but reserved our right in our agreement to get our money back through a court order. So we're initiating that work. We hired an attorney. If we're successful, we will get back about $3 million for this project. So these are some of the things we're doing to try to get some additional funding for the project. Having said that, in regard to the item in front of you, actually in this case, PG&E worked closely with us to drop and raise their lines near the POC to allow safe working conditions for the pile constructions. While the lines themselves do not interfere with the structure, driving the piles, however, and putting the cages required them to come take down their lines, which cross the freeway. So it required closure of the freeway. And then once we're done, they had to put them back on. They also installed a shoe fly to facilitate this work. In this case, they did work closely with us not to delay us. We had in other cases, you may have heard Ivan say, we asked for power service drop-ins for the project a while back, and we're getting a slow response on that. But they're finally moving forward. We would have loved to know about these cost increases before they happened, but unfortunately, they incur the cost, they figure out how much they spent, and then they tell us what it is. Their estimation process, not just PG&E, all the utilities, have not really been on target, unfortunately. They give us an estimate, and we're allowed to exceed it up to 25%, but in most cases, they even exceed that 25%. And there is nothing much we can do about it, since really it's out of our control. This is specialty work. They're the only ones who can do that work. And, it's based on their schedule. So it requires a lot of finessing and working closely with them, unfortunately. So with that, I'll be happy to answer any questions. We are seeking your approval of Amendment Number 1 to the utility agreement.
Thank you. Well, thank you for the report. So, I'll support the request, but I guess I have some questions. One is, looking forward, whether it's this project or subsequent projects, are there other ways that we can work with the utilities that will cause them to be more timely in providing us with information? And the second part of that question is, when we go out to bid, essentially we follow the procedure and we accept the lowest responsible bid, and therefore we have some control over the contractor. How do we know whether the costs we're being charged by the utilities when it's specialized work are reasonable?
Very simple answer is Susan Miller goes over every bill.
Yeah, and we also have the ability to audit them, and we've periodically done that. So we do have that ability to do them. We also meet.
And from those audits, do you concur that what they charge us is a reasonable cost for the work they're doing?
It is. Are they the most efficient? I would say, that there's some room to improve there, that they're not the most efficient. And we try very hard, as Hisham mentioned, to move the utilities ahead of our construction coming online, which we are doing on Balfour, because it does prevent the delay claims by the main contractor because of the utility companies. So that's usually the big money is in that realm where you are having delays by the main contractor. We're working hard. Ivan's working hard out in the field on Balfour right now to make sure we don't have that precise problem. But sometimes the utility companies have to come in because of the staging during the construction contract, and then you would look at allowing windows for how you're going to handle that.
Commissioners, it boils down to risk. How long do you want to, how many potholes or borings do you want to take to make sure that you have every utility identified in an urban corridor? And then how long do you want to wait as bids or the cost of construction rises versus letting it go and then dealing with it during construction? The other issue was there's a lot of things that are on the as-built, so we spent a lot of time at the end of a project documenting exactly what we did and where we placed every utilities so that next time you modify that roadway, the next contractor, the next owner that has to go through that process has better information. There's a lot of things in this area that they don't even know. So I've asked Ivan to take a look at the three things that he would change. And one, he said more due diligence up front, but you can spend a lot of money up front and you can spend a lot of money on the back end because your bids go up because you're delaying the contract. And then he's taking a look at making sure the designer, in this case, you know, the designer has some responsibility as well to do things right. And then what was the third thing, Ivan? I forgot. Because we had this conversation this morning, but I'm getting older. My memory isn't as long.
Zach, good morning, Commissioners. Ivan Ramirez, Construction Manager. So I'm always thinking of primarily Board Member Tatson. He always asks what was the lesson learned when I come up here, and maybe you all ask the same question. But yeah, so the first one was doing more due diligence when we are out there prior to getting to construction. Can't remember the second one, maybe, but the third one is that we also, if we're in a very urban environment like West County, because a lot of the work that we have done since I came here anyways is out on East County, which is pretty much, it's not as urbanized, but when we're in West County, it's very urbanized, and we have found out the hard way that there's a lot of utilities out there that we haven't really accounted for, and maybe the owners themselves don't know where they're at. So maybe we might want to have a additional line item as a contingency when we are in West County in case we hit some of these utilities that are going to end up costing us money. But I can't remember the second one, Randy. Maybe.
You're getting old too. So we had the conversation, time and materials to further answer your question. That's how PG&E bills, time and materials. And so they'll go in and they'll take a look at the bills, and then if they have to, they'll audit.
And then the follow-on question is, I mean, one of the items of concern in this particular case is the letter from PG&E is dated September, and they said they incurred the cost back in February. And we have a policy that if a jurisdiction comes to us late and has an overrun that they haven't told us about, we sometimes won't fund that. So that's one. But then follow on to that, we're now going to approach WICTAC. Have we been keeping WICTAC advised as soon as we can as to what the cost position is and whether we're likely to come back to them? Because we wouldn't want to do to them what we don't want done to us.
Yes, we actually went to WICTAC, I would say 3 months ago, when there was when they actually looked at which projects to allocate STMP fees for. We did submit our project at that time for $1 million, but the decision was made not to provide money for that project because there was no need at that point. And they mentioned that if there is a need, come back. And we talked to John Nemeth. We already made him aware of what's happening on the project. There is about $690,000 in additional WICTAC fees collected so far since they did their last allocation. So I've been in touch with John Nemeth about the project. In regard to the board, the project was talked about basically maybe 3 or 4 months ago at the board when they were addressing the allocations from the STMP program.
Yes, sir. Tom. You confuse me, which is not very hard to do, but on the contingency, you said we dropped from 10 to 6, and then we turn around. Did we put it back up to 10, or do we have any contingency left? And would there be also cause henceforth we don't drop the contingency? You got to cover the contingency.
Let me try again. I'm sorry if I confused you.
Don't worry, it's me. I'm all right.
When we awarded the contract, we normally award contracts with 10% contingency. In this case, because of the limited funding, because the bids came in higher than the engineer's estimate, we awarded it with only 6% contingency. We are expected, because of these increases, to exhaust and deplete that 6%. But if we get the $700,000 from WICTAC, our contingency will go back to 10% as it should have been in the first place. So with the $700 from WICTAC, assuming the board approves it, their board, our contingency on the project would have been 10%.
But for the record, at this point, we have no contingency at all.
We will be depleting our contingency. Yes.
Oh, this one, yeah.
That's
Any
the
other?
only button you play with unless someone's talking to you.
Okay.
Then you hit the
Got it.
elect.
Okay, so any other questions? Do we have a motion?
That we recommend that the
Motion by Tatson,
authority adopt the staff recommendations.
I'll second.
second by Taylor. All in favor?
Aye.
Any opposed? Okay, motion carries with 4 votes in favor, none opposed. Okay, next.
Chairman, if I just want to bring up the fact that this weekend we're going to close I-80 to demolish the existing pedestrian overcrossing, and this should be the last full closure. We have done 3 already. So in case you didn't know, I just wanted to inform you of that. Thank you.
Okay, next item, accept quarterly cash and investment report for the period ended September 30th. Do we have a staff report on that, or is that just?
Yes, good morning, APC Chair Trumbutt. My name is Randy Carlton. I'm the CFO for the authority. This particular item is typically on the consent calendar. We put it on for discussion today since this is the first look at the new investment report and an opportunity for the APC to meet the new investment consultants that we've hired back in July. So we want to take a little bit of time. We have some information prepared for you, probably 10, 12 minutes, and I'll just give you a brief overview of what to expect with the discussion. The Public Trust Advisors will provide an overview of our investment objectives, the services they provide to us as consultant. They'll discuss the performance objectives that we hold them to as our investment advisor. They'll provide a brief economic review to help put some of this into context. And then we'll also take a few minutes to go over the new quarterly investment report and, of course, address any questions you may have. So at this point, I'd like to introduce Tom Tite and Mark Krieger, and they will take it from here.
Good morning. Prior to me handing over to Mark to begin the presentation, I thought I'd just introduce ourselves and talk about our roles. Mark is based in our Los Angeles office and has day-to-day portfolio management responsibilities for your portfolio. My role is more on the investment advisory side. I work with Randy and his staff on things in addition to the portfolio, helping with your investment policy, cash flow analysis. Is that better? Okay. And other things like that. We pride ourselves on taking a customized approach with our clients. Your investment policy, your cash flows, your risk tolerances as a board are different than other entities. So I think what you'll see from Mark's presentation is that we pride ourselves on building out a completely customized investment solution that fits your needs and fits staff's needs. We really view our role as an extension of staff, not just a manager who comes and reports performance on a quarterly basis. So with that, I'll hand it over to Mark to talk a little bit more specifically about the objectives.
All right, thank you, Tom, and good morning, and thank you for having us. As Tom mentioned, my name is Mark Krieger. I'm a director and senior portfolio manager with Public Trust Advisors, and I presently serve.
Or use the other one. There are 2 of them.
I presently serve as the primary portfolio manager for the authority's account. So thank you for giving us the opportunity to come and speak with you today. This is a great opportunity for a lot of reasons. As Randy mentioned, we are a new investment advisor to the authority, so we want to take the opportunity to introduce ourselves and get to know you. It's also an important time because there is so much happening in the financial markets right now. We have an upcoming election, which could have very significant implications for trade and economics and the investment markets and our strategy on the portfolio. We have the situation in Europe with the Syrian refugee problem and the Brexit vote and civil unrest in many parts of that country, which are having significant implications for the fixed income markets in which the authority's investment portfolio is invested. And so we want to take an opportunity to talk through some of those developments, but also, as Randy mentioned, just review really what our objectives are in terms of managing your portfolio. And these are consistent with all public agencies' monies, where really safety is the primary objective. And in terms of safety, we take great care to manage a couple of different kinds of risks in the portfolio. Credit risk, obviously anytime we invest in instruments outside of U.S. Treasury securities, credit risk becomes a very important consideration. So we have a very built-out due diligence process for ongoing credit analysis, and also market price risk. And from a practical perspective, this is probably the most significant risk that most public agency portfolios face, and that is the risk that as interest rates rise, the market value of fixed income investments fall. And we're entering a period where the Federal Reserve is very likely to begin a gradual process, as we'll discuss later, of raising interest rates. In addition to that, we pride ourselves in transparency, which is one of the reasons we're here today. We want staff and the board to understand why all of the investments are in the portfolio and what role they're playing. In addition to that, and as Tom mentioned, ongoing communication with staff about changing circumstances, changing cash flow needs, changing risk tolerances makes sure that your investment strategy remains tailored even as your circumstances change over time. Also, compliance is a critical component of any successful investment program. So from that perspective, the authority's portfolio is managed subject to the California state statutes, specifically Section 53601, and also the authority investment policy. As of the quarter end of September 30th, the portfolio is in full compliance with both of those metrics. Again, another very important priority for a public funds portfolio is liquidity. And in terms of that entails matching investment maturities to known cash flow requirements of the authority, and also ensuring that the authority has sufficient short-term money set aside to cover both known expenditures over the budgetary cycle as well as any contingencies. And we'll talk about how the portfolio is tiered to accomplish those objectives in just a moment. And then finally, only after satisfying those paramount objectives of safety and liquidity with the eye towards transparency and compliance do we focus on opportunities to enhance the yield and return in the portfolio. And that entails utilizing active management strategies over time to improve the income that is generated by the portfolio. In terms of our performance objectives, there's a couple of different layers to that. The first one is we really want to be a true partnership, and as Tom mentioned, that really entails getting to know the authority, getting to know the board, getting to know your preferences, your risk tolerances, to make sure that we're affecting a strategy that reflects those unique needs. Tom mentioned again a team-based approach. We want to be an extension of your staff. That is a really critical component to a successful investment program. We don't just want you to be a number or a portfolio that we're managing. We want to understand your unique needs and make sure that those are reflected in your strategy. In terms of the performance in the portfolio, the authority's operating portfolio is benchmarked to the Bank of America Merrill Lynch 1 to 3 year Treasury Index. That's an index comprised of U.S. Treasury securities with maturities ranging between 1 and 3 years. Our objective over budgetary and in business cycles is to generate a rate of return that is equal to or greater than that index, because that index, really what it defines is the strategic amount of risk that the authority is comfortable with. And so we want to make sure that the portfolio over time closely reflects those risk parameters, and we will take active steps where we see value to increase the return relative to that benchmark over time. In terms of the project funds and capitalized interest funds that were established in connection with the 2015 bonds, the objective there is a little bit different. Those proceeds are subject to something called arbitrage or rebate, which means the investment earnings that you earn on those bond proceeds is limited to the cost of funds effectively on the bonds. And so the objective there is to earn a rate of return consistent with those cash flow requirements that helps you limit negative arbitrage, so earnings below what you're otherwise legally allowed to keep. So those are the different kinds of objectives that we're pursuing for the different types of funds that we're managing on behalf of the authority. And here is just a little bit of a graphical representation of kind of the tiered nature of the authority's portfolio. Across the bottom axis is just a time series. And you can see that in terms of meeting that liquidity objective that I mentioned, the authority maintains sufficient balances in the State of California Local Agency Investment Fund to meet those ongoing budgetary requirements and also provide some contingent liquidity in case there are some unexpected expenses that arise along the way. And then in addition to that, the capitalized interest funds are laddered in connection with certain debt service schedules in connection with the 2015 bonds. Those proceeds were part of the issuance that were designed to pay debt service for a specified amount of time on the underlying 2015 bonds. So it's a little bit of a shorter term portfolio because it's earmarked for 6 months, 12-month debt service payments. Then looking at the the project funds, we call bond proceeds here. We work very closely with staff to understand how those monies are likely to be spent on ongoing projects that are currently underway. And so we work very closely to understand what the timing of those cash flow requirements are going to be, and we schedule investments to mature in connection with those expected need dates. And then finally, what we call the core operating portfolio, which is the primary portfolio of the authority. That is invested, again, in a portfolio very similar to the Bank of America 1 to 3 year Treasury Index. And we'll go into those details a little bit later. But you can see, the key concept here is with money that has a progressively longer investment horizon, we can extend further out on the investment yield curve to pick up greater yields, greater earnings for the authority. A little bit of market update. As I mentioned, there's a lot going on in the world right now, and I know we're trying to achieve a 10 to 12 minutes. So I'm going to go through some of these slides, potentially a little bit quickly, but kind of the key point we want to talk about here is in the aftermath of the financial crisis, economic growth in the United States has been subpar, to say the least. It has been substantially below averages that persisted before the financial crisis. In fact, since December of 2009, the average rate of growth of the U.S. economy has been only 2%. That compares to a 3.2% average that persisted for the 20-year period ended December 31st of 2006. So there's been a significant downshifting in economic activity, and we think there are some fundamental reasons for that. We all see on a weekly or a monthly basis the economic indicators that come out, and then we see the volatility in the stock market as the market reacts to those very short-term indicators. We're taking a longer-term perspective in terms of our strategy in managing the portfolio, and when we do that and take a step back, what we observe are a couple of fundamental things that we think are serving to restrain growth. One of those has been, in the aftermath of the financial crisis, corporate profits as measured by the Bureau of Economic Analysis have been continuing to trend lower. That's the graph in the upper right-hand side of the slide today. Those are that's a standardized measure of corporate profits going back to 2009, and there's just been a persistent decline in corporate profitability. And one of the implications of that is that corporations have cut back very substantially on their CapEx spending or business fixed investment, the kinds of things that drive innovation and productivity. And not surprisingly, we have seen a commensurate and very similar decline in rates of productivity as illustrated in the graph to the bottom left today. And those are important, very fundamental factors that we think are restraining growth, because over time, the potential growth rate of an economy is a function of three interrelated things. It's a function of population growth and labor force participation. It's a function of business investment in the resources, technology, infrastructure that allow employees to do their jobs effectively, and it's a function of increases in productivity. And so right now, in the aftermath of the financial crisis, we've had a situation where both CapEx investment or business investment, which drives productivity, has been declining, and labor force participation has been declining. The lack of those cylinders kind of kicking in to the next gear has been a very significant restraining factor on domestic economic growth. The labor markets have been performing fairly well. Job growth has been averaging approximately 200,000 jobs per month, though we do note that there has been a downshifting in this year's performance relative to prior year's performance. In particular, for the 9 months ended September of this year, payroll growth has been averaging around 187,000 jobs per month, and that compares to about 220,000 jobs per month through the same 9-month period last year. That's not unexpected. We think that we're getting close to something called full employment in the economy. That's illustrated by the fact that the unemployment rate is down at roughly 5%, a slight tick up from 4.9% in September. But that's due to some technical factors in how the unemployment rate is calculated, and specifically an increase in labor force participation caused an uptick in unemployment. That's actually a positive sign, because an increase in labor force participation means that folks are getting confident to re-enter the labor force. So we're not anticipating presently any significant downturns in employment conditions. Other measures such as weekly initial jobless claims continue to be at very historically low levels and consistent with levels that would be suggestive of continued payroll growth, though we do expect the rate of payroll growth to slow in the coming quarters, just because we can't continue to add 200,000 jobs per month into perpetuity. As we approach full employment, we expect that rate of payroll creation is actually going to slow. In terms of inflation, we have seen prices uptick, and certainly we look at the data series associated with the Consumer Price Index running persistently above the Fed's 2% target. However, the Fed's preferred gauge, the Personal Consumption Expenditures Index, has been running persistently lower at about 1.7% through the end of September. We do expect that to continue to trend higher towards the Fed's 2% objective, but this has been one of the reasons the Fed has been so slow to act, is that inflation has been lower than expected for longer. So it's ironic that there's all this speculation about the timing of the next Federal Reserve rate increase. We anticipate it's going to be in December, but we think it's very important to keep in context that despite a 25 basis point rate increase potentially in December, the stance of monetary policy in the United States still remains exceptionally accommodative. The graph on the upper left, the line is just the historical federal funds rate. You can see we just boosted up off of the zero bound most recently back in December of 2015. We're expecting another 25 basis point increase here in December of 2016. In addition to that, it's also important to keep in mind that the Fed's balance sheet, which was the tool they used in the quantitative easing programs, remains exceptionally elevated. Prior to the financial crisis, it held about $850 billion of securities through the QE programs. That ballooned to nearly $4.5 trillion. The effect of that has been to take longer-term securities out of the trading markets, and as a result of that, it has suppressed longer-term interest rates with the objective of spurring financial market activity and capital formation. Even as the Fed does begin to raise interest rates, we expect the path to be very gradual. And the last comment here has to do with the bottom left graph is the Federal Reserve's what they call their dot plot. Each quarter they release an updated summary of their economic projections, and that includes a forecast based upon the individual voting members' expectations of where the federal funds rate will be at the end of each calendar year through 2019. The red line that connects those individual dots is the Fed's median forecast. The gold line at the bottom of that is market-implied expectations based upon the trading of federal funds futures contracts of where the Fed funds rate is going to be. The key point here is that the market's expectations of how quickly the Fed is going to raise interest rates is much slower and much shallower than the Federal Reserve is currently anticipating. And the trend has been that the Fed's expectations have continued to trend lower and become, over time, more in line with the market's expectations. That has implications for portfolio strategy, as I'll talk about in just the next couple of minutes. The implication of that has been a flattening of the U.S. Treasury curve as expectations of the Fed raising interest rates have continued to trend higher over the last year. We can see that shorter-term interest rates have trended higher, though against the backdrop of slow global growth, geopolitical uncertainties, and massive stimulus provided by global central banks, notably the European Central Bank, the Bank of Japan, has caused longer-term interest rates to be more suppressed relative to last year's level. So that has resulted in a significant flattening of the yield curve as measured by the spread between long-term securities and shorter-term securities. And you can see that the green and orange graphs just represent the change in yields across the yield curve over the last 1 and 3 months, but the blue graph represents the change in yields over the last 12 months. And so you can see that shorter-term rates over the last 12 months have trended higher. Those longer-term interest rates have actually trended lower on a 12-month basis. And that kind of concludes the economic update portion. We're going to move on to a review of the portfolio at this time. Tom, did you want to take a part of this?
Yeah, sure.
Okay.
I know that this part of the presentation was in your packet, so I'll briefly touch on a couple of the important slides and then maybe turn it over to questions. But as you can see here, this is just a summary of where the portfolio sits from a market value perspective, and that's listed on the left-hand side as of September 30. This is your core operating portfolio. This does not include balances in the CAP-I fund and or the project funds. If you look over to the right, you can see some of the metrics of the portfolio currently, or as of September 30, the book yield on the portfolio is just slightly over 1%. The duration of the portfolio is 1.67 years. I believe Mark will potentially talk a little bit our strategy to increase that a little bit, which we have. This is a summary of the return of the portfolio. This, if you look across the top, this is the total return of the portfolio versus the index. So you can see the trailing month, the performance matched the index, and then the trailing quarter and year to date, negative 0.05% versus the benchmark of 0.11%. That's a function, as Mark had mentioned, of interest rates rising through the period. Rising interest rates have a negative impact on the performance of the portfolio. And then I'll call your attention down the yield to maturity and the duration of the portfolio versus the benchmark 1.67 years versus 1.83. That's a measure of interest rate risk. So we're taking slightly less interest rate risk in the benchmark. But if you look at the yield to maturity of the portfolio at 87 basis points versus 78, we're out yielding it, which is where you want to be. Less interest rate risk, but we're able to add potentially more income into the portfolio. As Mark had mentioned, and I don't know if you want to talk about this, Mark, but not only are we diversified in different fixed income securities, we're also diversified across the yield curve. So you can see we have a well-diversified portfolio from 0 years out to that 3 to 4 year range. So as securities come due and mature in a rising interest rate environment, we're reinvesting into that higher rate environment to generate a little bit more income in the portfolio. And then on page 7 of 11, and I'll maybe stop here, just to point out this is a very, very high-quality portfolio. As Mark had talked about, we are governed by California state statutes and the authority's investment policy. The overwhelming majority of the securities in the portfolio on a Moody's basis are rated AAA. S&P has a slightly different rating on the U.S. government at AA+, but nonetheless, all of the securities in the portfolio are very high quality. And well diversified. Do you have any other comments?
No, Tom, I think that covers it. Thank you.
So I know we bumped up against our 15 minutes, Randy, but we're happy to take any questions or thoughts that we should ask.
Questions, Bob?
Yeah, not necessarily a question. What you're going to have to do for this old man, the font can't get much smaller.
No, it can't get any smaller.
Okay.
It's hard for all of us to read it. We couldn't read it up there.
And we can't read it up there. So I don't know, are they going to do this for the board?
No, this is just for the APC.
Oh, okay. Because we need to make sure we can read it. Because when we're trying to do this, well, you saw us. I thought it was just me, but I guess it is.
No, duly noted, and thank you for that comment. We will take steps to increase the font size for the next quarterly report.
And I think you need more charts.
How many more you want?
We might, Randy, we'll condense some charts. I think would be some, obviously they're very good charts and you've done a lot of work and that's to be commended. However, maybe we could put pertinent charts. That seems to be the political word lately, is pertinent. So I want to thank you. And so it's not questions, but it sounds like you really covered the bases, obviously, through the information you gave us. So I really don't, that was just comments, not necessarily questions.
And we appreciate those comments. We'll definitely take those into consideration the next time we're here and implement some changes to those.
Anybody else? Well, I had a couple of quick questions. So, after sifting through all this, what are the, are there any policy decisions facing the commission right now, or I know this is just an informational item, but it's kind of like, kind of what are the core takeaways? You're presenting to us, what you're doing and why you're doing it, and where you think the economy is going, and there's really nothing for us to do. It either works or it doesn't, right?
Yeah, I think that's right. There's no policy decisions before the commission at this point. I think, Randy, you had mentioned bringing up
That's
the
right.
potential.
Let me just follow up on that. Today is information only. It's accepting a new report, a report that you haven't seen before. The first part of it was economic information. The second part is the investment report, which is included in your packet, and I'll work with the team to condense some of that information. In terms of policy considerations, we anticipate having a conversation about that in June, Commissioner, but when we bring the investment policy to the APC and the board. One consideration that we're thinking about is changing an allocation in the investment portfolio for high-grade corporate bonds. Currently, The credit quality minimum is AA. We're permitted to invest up to 30% of the portfolio into that type of category. The world today, however, is that the number of AA or better rated corporations has shrunk, and it's becoming more and more challenging to find securities for the portfolio with that high grade investment qualities. State law permits single A. Many public agencies have moved to single A, and that's something that we will bring back to the APC and talk about, perhaps taking that 30% and changing it to 20% single A and a maximum of 30% single A or better. So that will be addressed in June. Today, staff is just asking for you to accept the report.
Okay, and then the second question I have is, we do something similar to this in our cities, but it's more about revenue projections than investment return projections. And what we're being told is that the current economic expansion is already far in excess of the average, and that we're kind of living on borrowed time, and we should expect a downturn at some point. So, what is that something that you're anticipating, and if so, what effect would it have on all this?
That's a great question. Yeah, so the current expansion, in terms of measured relative to the average of the past, expansions going back to the post-war era, is about 40% longer than the average. And there's an old saying that expansions don't die of old age, and I think that is true, but there are also right now presently a lot of imbalances built up in global economic as well as domestic economic conditions. We are forecasting a slowing down of growth going forward. The Federal Reserve is going to be raising interest rates into the weakest economic environment in history that they've ever raised rates into. They're not raising rates for the reasons they historically do, which is to slow down over accelerating economic growth. They're actually raising interest rates just to try to get interest rate policy back to some semblance of normalcy. We've been at zero for effectively 8 years. And that was an emergency response to the financial crisis. The key question is the timing, and when does that downturn occur? It could happen in the next 12 months. The expansion could continue for another 3 years. That is a challenging determination to make. In terms of the consequences, though, for an economic downturn for the authority's portfolio, the interesting thing about portfolios comprised of very high-quality investments such as this is they actually perform very well when the economy goes south. And the reason for that is when the economy goes south, there's a tendency for investors to sell riskier assets like stocks, commodities, currencies, and so forth, and where they reallocate that capital to is the high-grade fixed income markets. It's called the flight to quality. So when the economy turns south, the portfolio would benefit from a flight to quality, which would drive up prices and drive down yields in the portfolio.
Okay, any other questions? Does this need a vote to accept?
Yes.
Okay. Okay, go ahead.
One more comment. You guys, rumor has it, and obviously it's going to be a rumor until it's done, no matter, if Trump wins, it's not good. And if Hillary wins, it's not good. So what is good? And they were saying the first quarter is going to be a disaster. Your thoughts?
Yeah, it's a very good question. We've given the potential implications of various election outcomes a lot of thought, actually. And I could summarize our...
Say that sentence again.
We've given the implications of different scenarios of the economic elections a lot of thought in terms of how it could potentially affect the portfolios that we manage. So I'll lay out for you a couple of different scenarios that we see. The first scenario is a Hillary victory and the Congress remains split between Democrats and Republicans. That outcome is probably a base case scenario at this point, and it probably results in the least amount of disruptions to financial markets because it implies more of a continuation of the status quo. And so we would anticipate against that backdrop that interest rates would continue to rise because a continuation of the status quo against the backdrop of economic data that continues to come in line with expectations, that keeps the Federal Reserve likely on a path of normalizing interest rates, albeit on a very gradual basis. Scenario 2 is a Clinton victory where the Democrats sweep Congress. That would be likely a positive for the equity markets because of the increased spending that would likely result from that scenario, and would also potentially cause a more dramatic increase in interest rates on expectations of larger budget deficits as a result of that spending going forward. Okay? Both of those scenarios don't really result in any significant damage to the portfolio. As interest rates rise, the portfolio is not exceptionally sensitive to interest rates. Tom mentioned the duration is approximately 1.7, 1.8 years. I think some context to that number may be informative to you. What that duration number tells us is the market value, or the percentage by which the market value of the portfolio would decline if interest rates increased instantaneously by 1 full percentage point. And so a duration of 1.7 years tells us that 100 basis points, a 1% increase in interest rates, the market value of the authority's portfolio would decline by approximately 1.7%. It's not a precise metric. There's some other adjustments that you have to make, but it gets us into a very close approximation of that sensitivity. So 100 basis point increase in interest rates would cause the market value of the portfolio to decline on an unrealized basis by 1.7%. 1% increases in interest rates instantaneously have never occurred. It's a very low probability event. So what we start to do then is ratchet down those implications. So a 50 basis point increase instantaneously in interest rates is also an exceptionally low probability event. But what that tells us is then the portfolio market value would decline by roughly half of 1.7%, so approximately 0.85% or so on an unrealized basis. A 25 basis point increase in interest rates, which has occurred back in 2002, 2003, though very rarely, would mean then that the market value of the portfolio would decline by approximately 0.4% unrealized. So it's a very conservative portfolio from that perspective because fairly significant increases in interest rates do not result in very significant declines in value. And then when you spread that over time, the portfolio is continuing to generate very important income as well. A Trump victory is a little bit of an uncertainty because he has expressed some negative views on trade, and similarly he has expressed a desire to engage in very significant infrastructure spending. So our base case scenario under a Trump victory is very likely a fairly significant sell-off in the equity markets because it's not priced into equity valuations presently. It would be somewhat of a surprise. And the result of that would likely be a flight to quality into fixed income as investors sold riskier assets on the uncertainty of what Trump's ongoing policies might actually be. So the immediate reaction in our view would be a sell-off in the equity markets, a flight to quality into the fixed income markets, which would push interest rates down, the market value of the authority's portfolio higher. Then, however, after that initial kind of reaction, we think that the expectations of more significant infrastructure spending may actually cause yields to begin to creep higher after the initial kind of reaction.
And he fires Yellen.
I'm sorry? And he fires Yellen.
So he fires Yellen. What does that do to the Feds?
That's a very good question. We would have to wait and see who he may nominate for the next governor. He hasn't indicated any candidates
okay,
that we're aware of.
So you gave me a lot of, which I appreciate. What did you say? Did you say it's not really going to affect our portfolio?
Not in an overly substantive way because it's a very conservative portfolio and very high quality portfolio.
Right, Randy?
That's right. In summary, the flight to quality will benefit the authority.
Okay, we need a motion to accept this report. Motion by Tatson, second by Taylor. All in favor? Pierce, second by Pierce. All in favor? Aye. Any opposed? Okay, motion carries. Okay, item 11, proposed fund exchange agreement with the Metropolitan Transportation Commission to add $1.1 million to State Route 4.
I'll handle this, Mr. Chairman. We are asking you to approve agreement number 456 with MTC, in which CCTA will get $2.2 million in federal funds in return of giving MTC $1.1 million in Measure J funds. With the improved economy and the higher traffic volumes, as well as the opening of the new traffic lanes on Highway 4, in the westbound direction in the morning near San Marco Road, the traffic basically comes to a stop. It's a major bottleneck. And that's despite the RAM metering that's taking place in that section of the freeway. And over the past 3 weeks, we've been in close discussions with MTC staff to figure out a way to address the queuing problem on San Marco Road. Apparently, it's currently blocking people in their driveways, and it's perceived by the neighborhood that it's caused by the RAM meters. So we want to figure out, MTC basically wants to put on the table $1.1 million to study and implement near-term solutions at San Marco Road. Since federal funds are hard to use, as well as they have a very short deadline, this one has January 2017, the discussion basically developed into an exchange agreement between MTC and CCTA where basically we would use their $1.1 million in federal funds on San Pablo Dam Road interchange, the project that we just talked about, phase 1, which is already federalized, it's under construction, and it was set up originally with Caltrans to accept $1.1 million in federal money. We didn't know the color of the money at that time, but now that we know, it will be really easy to accept that money into the project. In return, we will free up $1.1 million in Measure J funds from the project to give to MTC 6 months from now after we use their money. And also MTC on top of that had agreed to give us another $1.1 million in federal money to implement solutions on San Marco Road after a study is completed of what can be done there. I don't think this is a bad deal. This is what you're after all, so we are seeking your approval.
Questions?
My only question is, a 2-for-1 deal is great. Are there any strings?
No restraints that I know of, not in the agreement.
Okay.
I mean, we will not give, there is enough language in the agreement to basically protect us in case something goes wrong.
Sounds like a good deal.
Okay, motion? Motion by Taylor, second by Pierce. All in favor? Aye. Motion carries with 4 votes. Commissioner and staff comments, are there any? Hearing none. Other business? Hearing none, we are adjourned.